record. All right, so thank you all for attending. This is, I guess, our third official meeting as the Left Field Investor Group. Prior to this, we've been meeting since March, and we were kind of unnamed there, but now we're big time with a website. So I'm glad you all could be here. Thank you very much. And if I get distracted, I have to keep adding people from the waiting room, so please be patient. I just wanted to remind everybody kind of what our mission and what we're going for here is. We're trying to create a community of like-minded investors who are interested in creating wealth through passively investing in real assets that produce actual cash flow. And our community is focused on networking and education, and that's what these meetings are about. We're hoping that we're going to do at the end a little bit of networking, hopefully, and throughout we're going to be hopefully educating people. We do have a website out there at www.leftfieldinvestors.com. It is a work in progress. We are currently updating it, making changes all the time. So if you see it changing, it's because we have people working on it. We're going to have some tools on the website, a deal analyzer that we're pretty excited about, a sponsor screener, so you have questions that you can ask your sponsors. Chad and I talked about a deal tracker today, which from what I understand, almost nobody has a really good deal tracker where you can put in all the information from the deals you've invested in and kind of find out, performance and track the distributions that are coming your way. And Chad and I made some pretty big headway on that space. So we're really excited about that. And we hope to have in the website sponsor reviews so we can, in our group review sponsors and share information about them. And all of those tools will be in what we're calling our infielder group. And there will be some type of subscription model for that so we can, try to cover our expenses. And we think some of these tools have a lot of value. And so we want to see if we can monetize that a little bit. We're not in this to make a bunch of money. As I said, we're in this for networking and education, but we do have costs that we would like to cover. Regardless, the blogs, the meetings, the resources, the discussion forum, which is not operational yet, and the syndicator list, all of that will be available regardless of whether you subscribe or not. So that's just something to keep in mind. We also have a presence on Facebook, which is really just a place that people want to go and find out about us, and to get them to the website is the goal. We don't really have plans to do a lot of networking or discussions on Facebook. We hope all of that comes to our website and our meetings. Also, MailChimp. Today I had some serious email problems, so if you got multiple emails, I apologize. I'm moving everything to MailChimp because once you get above a certain number of people that you're sending emails to, Google gets angry with you and starts rejecting emails. So we're at the point where I'm going to have to go through MailChimp. So if you're getting stuff in spam from MailChimp, just make sure you okay emails from us. Finally, I'm going to send out another survey to where what we're trying to do is kind of figure out what our group is investing in, meaning like it'll be anonymous, so I'm not going to track who sends what, but I want to try and get a sense of how many deals our group is invested in this year, which different sponsors we've invested with this year, and how much total we've invested. And we'd like to try to track that and just every once in a while get an update about what our group is doing, just to kind of get a sense for who's not who, but where we all are investing and how much. So that'll be coming out hopefully in the next couple of weeks, so we can kind of get a 2020 in review. And so we will have a speaker today I'm going to mention in a minute, but at the end, after this, Ian is done talking with us, we're going to have a couple of people who are just going to introduce themselves and kind of talk about their journey in passive investing. Our group is getting too large to go around and introduce everybody every time. So, but we'd like the whole group to get to know everybody. So we're going to do these kind of slow rollouts of introducing people. And then at the very end, we're going to try something, these Zoom rooms. I've never done this before. As with everything in this group, we're kind of just flying by the seat of our pants and hoping that once the plane's in the air, we'll figure out how to land it. So we're going to try Zoom rooms at the end. If it doesn't work and it disappears, see you next month. But hopefully we'll get everybody in a room where then we can, in a group of 4 or 5, we can each take a couple minutes to talk about how we got to passive investing, introduce each other, and just network a little bit. I know it's not the same as in person, but it's the best we can do, and we're gonna give it a shot. So with that, I am going to share my screen so I can get the stuff on Ian up here so everyone can see it. Hopefully you can see that. So Ian Kurth is going to be our speaker today. And, you know, I joke about Ian when we're talking in our groups. You guys have probably heard me before. There's a guy I know I met through networking and another group I belong to. And when he says he's investing in a deal, I always joke that I don't even look at the deal. I just jump in. It's not 100% true, but it's partially true because Ian knows his stuff, smart guy, and you know, he's been doing this for a while, and so I trust and value his opinion. I would follow his investments anytime, even though I'm not going to talk much about this, but he is from up north. The only thing I'm going to say about that is he's a graduate of Michigan State, so I'm going to call him a Spartan, and I'm going to ignore his undergrad, no offense. But that's all I'll say about that. He's a radiologist, a partner in a radiology group. You can see he's completed the Ironman 9 times, which is fantastic. The reason he's here today, he's invested in more than 50 private placements for multifamily, mobile homes, self-storage, lending, crypto, startups, and a lot more. So with that, I am going to turn it over to Ian. And if you're not on mute, please mute yourself. And Ian, we'll try to, if people have questions, I'll try to have them jump in. Or we can also have questions at the end. So Ian, go ahead and
Sure.
Thanks for being here.
Sure. Thanks for the invite. Hey, can you allow me to share my screen? Or,
yeah. Let me stop my share and then you should be able to, oops, stop share. And then hold on a second. There you go. You should be able to get in now.
Okay. Let's see here. And if I go. So thanks again for the invite. This is very, I speak a lot in medical environments, but frankly, I don't speak a whole lot in financial situations. Part of that is because I'm a physician and we don't talk about money. And part of that is because you know, I certainly don't have anything to sell. I don't have any objective here other than to hopefully provide some value to you guys and maybe share some of the things that I've learned along my journey and hopefully find some commonality amongst you and, you know, facilitate discussion and dialogue to further everyone along the path. You know, I didn't put all this stuff up here just to sort of do any sort of brag. It literally is to try and find some commonality amongst us. And I literally did not know that I was heading into the belly of the beast here with a bunch of Columbus people and having to fend for my life along High Street virtually. But hey, we'll set that aside here and.
Hey, Ian, just so you know, not all of us in Columbus are Buckeye fans, so you do have some support here. Just so
Thank you. I did know that, and in fact, there is a clandestine sort of club down there that I do know exists. So thank you for speaking up. So anyways, I wanted to make this as informal as possible. And certainly if you have any questions during this, please speak up, interrupt me, challenge what I'm saying, ask me why. Because what I'm hopefully going to accomplish is to give just a quick synopsis of my background, where and how I got to where I am right now. And hopefully along the way, we can share some of my experiences, but also give sort of a perspective from a high level of how I try to make decisions, what my decision-making framework is, how I try to construct a portfolio, and then you just do a sort of a case example of drilling down into one niche of that portfolio to sort of explain the things that I'm looking for and the reasons why I'm looking at those things. So with that, you know, I come from, you know, very humble background. I grew up in Michigan. My mom was a school teacher. My dad was in real estate. And he was in, you know, it was a formative experience seeing him in his experience. He was an entrepreneur in real estate, did basically everything there is. He had a single family portfolio at one time, did fix and flips. He was on the agency side as an agent, as a broker. He was on the lending side as a commercial loan officer. He did multifamily developments. He did commercial. He was all over the map. And he very much valued sweat equity, being very involved in his real estate endeavors, which by mandate necessitated dragging us along. And so I learned how to hang sheetrock. I learned how to mow lawns, do landscaping, paint. I painted a lot of buildings. I learned how to do all those things and realized, frankly, that I was not very good at any of those, and I didn't like that at all. And I basically shelved all things real estate for a long, long time, thinking that it didn't have applicability because I associated being actively involved with real estate investing, even though I had some sort of inclinations that I knew that not everybody had to do it that way. And so I set upon my journey of becoming a physician, and that, as some of you know, is a long and arduous sort of task where you just run the gauntlet for 10 years. You're staring at white walls in hospitals, and you donate your 20s, and eventually you exit that gauntlet on the other side, presumably capable in your profession, but certainly under-informed on the investing side, on the money management side, on what are you going to do with your income, and how do you handle all of this, this relatively high W-2 income. And as I exited that, I realized that very quickly that I had accumulated a debt problem. So I had some student loan debts. I had some car loan. I immediately, bought a house on a lake and took on a huge mortgage and didn't like that at all. And so, being hardwired to solve problems, I said, all right, I'm going to solve this debt problem. And so in similar fashion to putting my head down and plowing through the medical training, I put my head down and plowed through the Dave Ramsey program and went through baby steps 1 through 5, in 3 years, and got rid of all my consumer debt and did the debt-free scream and all of that, and said, okay, now what? And so that worked kind of well. So I continued on and took his money management advice, which, as many of you may know, is fairly simplistic in that you're just basically in equities. You put your money in index funds. You diversify in international, small cap, large cap. And so I did that for a few years. And fortunately, I was rescued from that sort of outcome by my dad again in 2010, where he said, "Hey, I'm going to do a project down in Florida. It's sort of a value add, high end VRBO type project. I'd like you to come along as a partner." And I did, and that happened to be a very good experience at the time, because it got my cognition changed from the inevitable of being just in complete equities along with 99% of my physician peers, and then kind of opening my eyes to the fact that I didn't have to actually do the drywall. I didn't actually have to pour cement, and I could be an investor, albeit in a quasi-active way, in real estate. And so I developed that portfolio. We did another project in 2012 and did a little bit more beyond that. And over the course of time, in about 2015 or 16, in April, I was nauseous again at the tax bill that I was paying, and each year that sort of that feeling would brew around that time, and at around that time, I just said, okay, again, being hardwired to sort of solve problems, I said, I'm gonna solve this problem, and that set me on another journey, which brought me to where we are right now, which I didn't know at the time would involve, all kinds of things in alternative investing and asset protection, in contracts and business ownership and angel investing and life insurance policies and cryptocurrency and all of these kind of things that are sort of weaving in together, that sort of were not necessarily mutually exclusive, but with a bit of creativity, you could sort of merge them into a strategy that would sort of resonate with your own with your own sort of DNA. And so that brought me basically to where we are today, where I have a portfolio, as Jim had mentioned in the introduction, of around 50, I think it's over 50 private placements, primarily in real estate, and all kinds of different niches. I value having a portfolio elements that are completely passive on the limited partner side. I value real estate investments where I'm passively active. And then I also value portions of my portfolio where I'm actively generating income. And I think there's synergy in all of those arrangements, both from a risk management standpoint and also from a tax mitigation standpoint. And so, with that sort of background, I wanted to sort of offer a couple of sort of, I guess, tips or tricks or bit of wisdom that I've sort of used along the way that seems to be helping me, and that I like to share with others whenever I can, for how I sort of operate from a decision-making standpoint, and then we'll sort of go into just basically how I try and structure my portfolio, and then just go into some of the elements that choosing an operator in the multifamily realm offers. So, I know a lot of you guys are podcast junkies, and that's great. I am too. I think it's a terrific way to digest a lot of material. I think you can get a lot of education, and that's very convenient. And Cash Flow Tactics, it has a podcast. They have their own investment sort of ecosystem, but they have brought together what I had been using for a long time and coined sort of a very eloquent marketing phrase, which is mindset, skill set, network. And so these are the three sort of big categories that I try to get better at each day. I try to take the Kaizen approach. I try to incrementally improve in each of these three categories. And I think before you can succeed in anything, you have to believe it. You have to have the mindset that you can actually accomplish something. You have to assume an identity that will be in alignment with success. And there's a quote from Henry Ford here that whether you think you can or you think you can't, either way you're right. So if you doom yourself from the start by not believing that you can actually accomplish something, you've unnecessarily sort of applied a ball and chain to your objective. And then once you have attention to that, and you're developing that, and you're fostering that, and you're really sort of I don't want to get into all of personal development, but you actually do need to sort of pay attention to these kind of statements that you tell yourself. You actually have to develop a skill set to accomplish whatever objective you set out to. You can't just will it into existence. You can't be, what's that movie where the Secret, where you can just wish it to be true and it comes true. It doesn't work that way. So actually I have to develop a skill set, and that skill set needs to be, in my opinion, as broad as possible across as many disciplines as possible. And Charlie Munger has a quote where, to the man with a hammer, every problem looks like a nail. You don't want to be a guy who just has a hammer and just trying to solve every problem with a hammer. You want to be able to sort of eloquently solve whatever you're trying to solve with the correct tool. And that might be a particular portfolio element. It might be like a cash flowing investment. It might be an appreciating investment. It might be in a particular geography or particular time frame, or it might have a particular debt structure that you're interested in, or it might have certain tax advantages that you're looking at. But either way, the more that you know about these, the more optionality that you have in putting together the tool belt that you can use, the skill set that you can use, the better you will be ultimately. And the way that you kind of get to that point is just what you guys are doing right here, is developing a network of sort of like-minded people who will where you can learn from each other, where you can ask questions in a safe environment, where you can impart wisdom, you can receive wisdom, and having the right circle of friends, it should not be discounted. It is an incredibly powerful way to level up yourself and to increase your own sort of thermostat in whatever realm you're doing. So for instance, in triathlon, I surround myself with guys who are much faster than I am, who are training harder than I am, who are training longer, and I pick up habits from them. Same thing goes with anything that you want to do. If you want to be a musician, you should hang out with good musicians. If you want to be a good investor, if you want to particularly be a good investor that has the capability and the skill set and the mindset to be successful in the realm that we've all sort of chosen, which are basically asset-backed, cash flowing products, you should speak the language. You should be around the people that are doing it and are good at doing it, and they can help you out. So, my overall portfolio objective generally is to balance two sort of extreme sides of the portfolio. And on one side, I'm in a minority in advocating for substantial cash reserves in some equivalent. It can be cash, it can be muni bonds, it can be high cash value life insurance. It doesn't really matter, but just easily accessible, extremely safe, not going to be down 40% on the day that you need it type of liquidity. And the reason for that is multifold. One is to insure yourself against life. It's not life insurance. It's to insure yourself against life. Nobody knows what's going to happen tomorrow, tonight. You don't know. You don't know what problems are going to arise. And if you have a problem that can be solved by money, you don't have a problem. So if you have enough money that can solve issues, you sleep better at night, and you have this cash reserve to mitigate out what I expose myself to, which is on the other side of the equation, which is basically illiquid investments, where I'm expecting an outsized return in exchange for lack of control, but tax advantages, but higher return cash flowing. But I'm ceding control in the majority of those investments, and I don't know when that is going to come back around to me. And case in point, like this year has been a case study in that, where everybody's expecting certain returns and COVID hits, and nobody was expecting that, and everything's up in the air, and you were thinking that you were going to get cash distributions, and that's what you're going to pay your mortgage with, and suddenly those cash distributions aren't coming, and what are you going to do? And so, if you have a substantial liquidity, you can meter out that, and you can risk adjust yourself. And so that's kind of my big sort of picture, how I tend to structure my overall portfolio. If we were to take a portion of that portfolio and dive into how I would sort of try and tease out the elements of selecting the operator, the geography, the deal in let's say multifamily, my goal in this, and this sort of applies outside of multifamily, but in general, the goal is to build a profitable, tax-efficient, asset-backed, hyper-diversified, tax advantage portfolio across geographies, niches, sizes, business plans, and time horizon. Now, it sounds like a mouthful, but if you actually break it down and think about it, when you cede control in a particular investment, you need to sort of risk mitigate that in a way. And there's a couple of ways that you can risk mitigate that. One is you can vet the operator and get to know them as well as you can. And the other is that you can make sure that each investment that you have is not existential, meaning that it's not going to take you down. You want to stay in the game. That is the game, is to stay in the game. And if you are, if you're so invested in one particular investment or one particular region or one particular operator, and something happens, that life events happen, and something happens to that, you've just unnecessarily exposed yourself to basically existential risk. And so as a passive investor where you cede control, the way that you can mitigate that, in my opinion, is to put little seeds all over the place in all kinds of different environments, across different time horizons, across different geographies, across different operators. And that way you can sort of, you can risk adjust that portion of your portfolio that is basically out of control. The second philosophical issue that I try to pay attention to, it's difficult to conceptualize, it's difficult to explain, but you have to understand that there's a dichotomy in social proof diligence, meaning you need to really know that if everybody on a podcast is talking about a certain thing, like it's easy to sort of just get on the bus and go. But if you were to expose that podcast to somebody who is, take for instance, only involved in stocks and bonds, like they would, throw up basically, and they wouldn't understand it. So you have to understand that while it is a good thing to surround yourself with like-minded individuals, you need to be aware that you can be exposed to the lemming issue, where one person says, hey, follow me, and everybody just blindly follows them, and you're all walking off the cliff. So, as an investor, awareness of this type of bias, in my opinion, is really important. It's difficult to tease out, it's difficult to explain, it's difficult to sort of conceptualize, but at least articulating it, at least acknowledging that it's there, may remind you to actually try to think independently about your own portfolio and what you're trying to accomplish with each particular investment. And then if we were to sort of take a sort of multifamily, my prioritization list for how I would take on or consider a multifamily deal my priority would be to vet the sponsor, then vet the market, and then vet the deal. Lots of people bring me deals and I don't know what to do with them because I don't know the market that well, and I certainly don't know the sponsor. And so to me, like, anybody can put together a spreadsheet and fill in numbers, and it doesn't make any, it doesn't make it right. It doesn't make me understand it anymore unless I know the sponsor and what they're trying to accomplish, and kind of work backwards from that. And so in trying to select an operator, what I am trying to accomplish is to build long-term relationships with best-in-class operators who continuously under-promise and over-deliver. And it's a big ask, and it takes a while to do. It takes relationship building. It takes experience. It takes throwing a boomerang out into the fog and hoping that it comes back and hits you in the head at some point. It takes that type of leap of faith to actually get into that relationship, but it's worth it. And at some point you sort of have to sprinkle it across a couple of them, and you sort of see how they do and see where your comfort level is, and you narrow it down until you find the one jockey or several jockeys that you really, really like. And the reason for that is it's more time efficient and it's more predictable in that way. If you were to evaluate every single deal that came your way, you would run yourself nuts. But if you have taken the time as a passive investor to vet the operator to the extent that you can, now you have that solved, and you sort of know what their buy box is, you know what their business plan is, you know their execution capabilities, and because presumably they're very disciplined in that, you basically know the general structure of the deal, and you can kind of quickly say yes or no, I'm okay with that because it satisfies this particular portion of my portfolio need. For these particular opportunists, I want people that are widget makers, that they're basically just doing the same thing over and over and over again, and they get better and better and better at doing it. I don't want somebody who's just like looking for a deal over here or there, because what that does for me is I need to actually investigate all those deals, and it's very inefficient for a passive investor to go along with a guy who's an opportunist and who doesn't necessarily have a lot of deal flow. So the other thing is I'm looking for very resourceful GPs. I'm looking for people who can problem solve, because again, nobody can predict the future, and whatever that comes on your pro forma spreadsheet, it's going to get destroyed, within quarter one or quarter two of whatever you're moving into. You just have to acknowledge that. But what you want to do is find a manager who can actually handle those challenges. And so I'm trying to find those GPs who can handle COVID, they can handle financial crises, they can handle political unrest, they can handle, a big employer that leaves and they have to suddenly sort of make adjustments into their local market. And I want operators who have incentive alignment and skin in the game. So once you get past that level, then obviously you want to pay attention to geographies. I'm not really a fan of like investing in multifamily in North Dakota and in sort of rural Kansas. No offense from anybody who's there, but it doesn't satisfy the criteria of having, a very sort of urban center where there's population inflow, there's job growth, there's a diversified employment base, all from a risk mitigation standpoint. And then you get down to the deal, and each deal should again serve a purpose for your portfolio. Sometimes you want cash flow, sometimes you want value add, but in general, I like to have value add components because that tends to de-risk the deal, particularly if it's light value add, where it's just a managerial sort of tweak where they see that something is mismanaged and they can go in with appropriate management and fix that. That's a very easy value add play. And if you can find those asymmetries in the market, those are generally good. You certainly want to have conservative underwriting. And you want to have somebody who's got reasonable fees, and I prefer direct ownership for these type of deals rather than a fund model. Fund models work well in certain other investments. For me, my preference is to have is to sort of create my own fund of direct ownership in multiple deals. And then the other way that you can sort of evaluate the deal is the timing and the types of returns that you're looking for. I'm going to close out by just giving an example to Podcast Junkies. I'm not sure if anybody is familiar with him. If you're not, you should be, in my opinion. His name is Jocko Willink. He's got a terrific podcast, and I really, really like his story in that he's a sort of a modern Stoic. He has his story is impressive in that, you know, he was a Navy SEAL, and so that in itself is very impressive in my book. But almost as impressive as that is that he was in a confined sort of military environment for 20 years, and then he left that and exploded as an entrepreneur. This guy owns a jiu-jitsu gym. He owns a bunch of real estate. He owns a manufacturing facility in Maine. He has a leadership consultancy company. He is, he gets over 100 grand a speech now. He's got a crazy podcast. He's an author. He's a surfer. He's a musician. Like, he is a guy who does a lot of things. And as I mentioned, he has a multidisciplinary sort of approach and talks about that frequently, about how, he quotes Musashi quite frequently, whereas if you know the way broadly, you see it in all things, and you find these commonalities in different segments of things that you know well, and you can apply it towards investing, you can apply it towards business, you can apply it towards your own life and make your own life better. And there are certain tenets that he advocates for that I think are appropriate in making yourself a better human and making yourself a better investor. And they're laid out here. I mean, these are simply said and sometimes difficult to actually act upon, but being aware of them and sort of acknowledging them, I think is very fruitful. And certainly humility in investing is a character attribute that is something that will serve you well, in my opinion. You have to balance dichotomies. You have to have ownership. You all have chosen to take more ownership of your financial future by becoming investing and becoming your own best advocate. You're willing to sort of take action and sort of be default aggressive. You're willing to be disciplined and sort of chip away at this thing and know that planting seeds will eventually sort of yield a success down the road. And you all are here to get after it. So I applaud you for that. And so I appreciate the opportunity to sort of share my story and share sort of some of the things that I've learned along the way. And frankly, I do best when I'm sort of just in a sort of more one-on-one interaction, and we can sort of just shoot the bull and try to solve problems. So I would welcome any sort of comments or questions, and hopefully we can establish a dialogue for the remainder of our time here.
Thank you, Ian. That was great. A lot of good stuff in there. I have a couple of questions, but I'd like to open it up to the group. If you just want to unmute, and then maybe I can just assume that if you're unmuted, you have a question. Jeff, is that the case?
Yeah, I can ask one. And thank you, Ian. That was really great.
Sure.
I'm pretty new to this and just getting started in my first couple syndications. I guess one of them, I was interested that you commented on a direct property versus investing in a fund and your preference for the direct ownership. Can you expand on that a little bit more, on the preference, if you will?
Yeah, so it's a great question, and thanks for answering that. The reason, particularly in multifamily, that I choose direct ownership is that because I can, I know the property. I can vet the property. I can look at it. It's tangible. It's one asset, and I know I can better sort of assess the risk reward elements of that particular investment. When you embark in a fund, basically you're giving capital to an operator, and that operator then has much more discretion as to where they apply that capital, and it may not align with what you're trying to accomplish. So they have a fund. Generally there's descriptors and structure to a fund, but it does give the operator the sort of liberty to allocate the capital more liberally than if you were just to give them for one particular deal. And so there's that issue. There is the concept of sort of dead capital, where your capital isn't actually moving for a time when you're in a fund structure. And that in itself can also, whether overtly or subconsciously, motivate a fund manager to feel the need to deploy that. And they may deploy it into a project that is not in a disciplined way. And so I would prefer to keep that discipline to myself and apply it how I see is most advantageous to my portfolio, as opposed to ceding more control, in my opinion, to an operator in a fund structure. Now, there are certain things where funds make more sense. I mean, like life settlements is an area where fund structure might make more sense. You know, a common example is ATMs. A common example would be, what else is a good fund? Like, you know, obviously a mutual fund where you can sort of spread things out. But when I'm dealing with real estate and the particular nuances of multifamily in particular, I prefer direct for those reasons.
That was great. Thanks, Ian.
Yep.
Mark, did you have a question?
Yeah. So Ian, thank you so much again for the presentation. You're obviously extremely busy, so thank you for taking the time to do this. Yeah. So a couple quick questions. One is, do you kind of have a goal as far as returns, as far as kind of what you're shooting for? Maybe more short term as far as cash on cash returns, and then kind of more long term as far as annualized returns, or internal rate of returns. And then also kind of a separate question is, what do you feel like has really worked for you best? You've been doing this, I think you said, for at least 10 years or so. Which deals kind of have really worked well for you and have really gotten you great returns and something you've really enjoyed?
Yeah, those are great questions. I don't have a hard stop for returns because it generally, when I approach the portfolio, I'm trying to solve a particular issue, and it may be I need something that is more stable and cash flowing. It may be something that I'm looking for a little bit more appreciation, and I don't need to see those returns for a while, and I'm willing to sort of take the risk. It may be something where I'm looking for a tax advantage, and so all of those kind of play in. And so, but in general, I'm trying for the illiquid side of things, not the cash, which is a drag, and I acknowledge that drag. But on the other side, I'm shooting for greater than 15, and I'm happy with 10. And I know that, and even sort of with those metrics, I'm always looking to try and get 20s, but in reality, like, to do that on a consistent basis is really, really challenging. Now, you can do it if you combine sort of strategies in that, you have, you stagger like different refinancing options where you can get your money moving in two different places. And so the same dollar is doing more than one thing. And if you actually sort of got quantitative about that, you could approach those higher end numbers. And that's what I do, but I don't necessarily have the resources or frankly the interest in sort of tracking all of that. I just know sort of intuitively that that's going on, and that I still maintain equity in this, and I've got a refinance going, and I put it in this, and that's gaining that, and I'm getting cash flow from that, and that cash flow is going over here. And then this thing, I got some high cash value life insurance, which is growing up, and I'm gonna borrow that out at a tax advantage, and I'm gonna put it over there. So that $1 is doing a bunch of different things, and I know that intuitively, but I don't have a quantitative answer for you. And then in terms of what is my best investment, I don't know. I've just gravitated more towards investments that are asset backed, that are cash flow positive, that provide a tax benefit, and that I can sort of work into a business structure where I'll have additional sort of tax benefits for the managerial side. That's what that has really merged best with my own sort of approach. It's not for everybody, and And I'm not here to sort of be dogmatic about any of this stuff. And what I'm actually advocating for all of you to do is to put it through your own filter, put it through your own lens. What are you most comfortable with? What resonates in your household? All of those things, those are very independent, individual decisions. And you have chosen not to cede those decisions, which I applaud you all for. And you really need to trust your gut on those and do what's right for you and not be a lemming and just follow everybody else.
That's great. Thank you.
Mm-hmm.
All right, Frank, did you have a question?
Hello, can you hear me?
Yep.
Yeah. Question I had to Ian was about the substantial liquidity portion. Is there a model that you follow, or is it a certain percentage of net worth or something like that you want to keep liquid?
That's a great question, and I think a lot about that. And I what I've come to sort of believe is that it probably changes with, I think there are gradations for it in terms of, I don't know that there's a certain percentage that applies to everyone. You hear over and over, like, make sure you have 6 months of liquidity, but I don't know that applies when you are in a higher net worth echelon or even a very, very high net worth echelon. I don't think it applies there. And I don't think that it has the same impact across everything equally. And as I've sort of become more attuned to the question, me personally, I feel most comfortable when I am greater than 25% of my net worth is on the cash side, frankly. And most of the time it's greater than 30-35%. And it dips down because it's an opportunity fund, and I'll put it out there. But as soon as it dips down, I'm replenishing that with cash flow coming from all sources to sort of keep it at that level. And I just like that because I found over and over again that really good opportunities come, and the more that you recognize those and the more that you can seize them, and you have dry powder, if you will, to capture those, that to go back to Mark's question, that helps you elevate your returns because you didn't miss it, because you were strapped and you had this and that payment going out, and you just had to let it go away. So again, I know I'm in the minority here, but I've done well with that. I really feel comfortable with that. And if you think back to, when, if you analyze why businesses or real estate projects fail, it's lack of liquidity. It's pure and simple. That's why. Like in 2006 or 7, like many projects were over levered and they just didn't have capital, or they had a capex exposure, a financing call, and the renters left and they didn't have any cash in the bank, and suddenly they have to hand over the property. And the way that you mitigate that is to have liquidity. People who had liquidity in 2006 and 7, they managed to get through that, and they actually were able to apply that liquidity when prices eventually fell, and they got on the best ride that we've had in 50 years. So
excellent.
Thank you.
Sam, you got a question?
Yeah, thanks, Jim. Ian, thanks for taking the time. I appreciate it.
Sure.
You and I actually spoke a couple months back. We met up through Buck Joffrey's podcast, but I think we were talking a little bit about conservation easements at that time, but also a general investing strategy. I don't know if you recall. Probably not. I'm sure you talked to a ton of people, but
sure.
But thanks again for taking the time. I appreciate it.
Yeah, no worries. No worries.
One of the questions I had, and sort of the thing that I'm struggling with right now in this sort of current COVID environment that we're in right now, I'm curious how you're looking at things both in the sort of overview, like in terms of if your liquidity has changed or your use of your liquidity in this time frame has changed, and whether or not to make moves now or kind of stay on the sidelines for a bit. And then secondarily, more specifically in terms of what you're looking at in deals. Has that changed in the environment we're in now? I mean, or are you still kind of looking for the same things, or have you modified some of the criteria that you look at when you're vetting some of these deals?
Yeah, it's a great question. I don't know that I have, terrific answers for it. I can tell you what I have done is I haven't changed my liquidity sort of allocation, but I'm willing to change it if I see the market drop. So this is the case where I'm not necessarily trying to pile up more, but I am anticipating that, if the market does drop, and it may not, but if it does drop, I'm willing to sort of double down into that drop and come out of it, and then sort of backfill the liquidity later. I'm not necessarily going to obviously sort of lower my liquidity now, because I still think there's quite a bit of risk out there that has not yet manifested with just COVID but that said, like, I think there's uncertainty like frequently in the market, and this is just a little bit more obvious to people right now. But if you think about the investments that you're generally involved in, this group is generally involved in, which are, 3-5 year investments, most of those are going to sort of have this kind of stuff going on throughout the course of it. And, if you were to invest in these things 2 years ago and COVID hit, well, like it's 2 years into a 5 or 7 year hold, it'll probably be okay, kind of thing. And so it hasn't necessarily sort of changed the way that I've continued to deploy capital this year, other than I am anticipating, and again, I can't predict the future, but I'm anticipating having the willingness to sort of lower my liquidity ratio in the near term to sort of get a little bit more out there if the market does dip substantially.
Makes sense. Thanks, Ian.
Thanks.
Sure.
And Brian Meyer, you got a question?
Yeah. No, thanks again, Ian. Question, along the lines of liquidity, talking 25, 35%, that's a big chunk of money. Yes. What investments are you putting that in? I heard you talk about cash value life insurance a little bit, so I'm assuming that's one you're using. Where else are you? And you continue to talk about how you diversify that pool of money.
Yeah, it's a great question. So I found that high cash value life insurance policies tend to be the best rate of return for liquidity. In general, it's, in my opinion, they're very painful to prime. It's a long play. So it takes, 5 to 7 years to actually prime these things so that they're actually working. And it's challenging to try and figure out what allocation that you can deploy in a consistent basis over that time frame. But once you get those policies matured, you can't find a more efficient way to hold cash. So I try to pump as much as I can into that. I try to invert the way I think quite frequently. So a lot of people just forward think. I try to actually go to the objective and reflect back a little bit. And so if I'm inverting from myself 20 years from now, would I be more or less pleased with having a ton of high cash value optionality in 20 years? And universally, the answer is yes. I would love that optionality. I would love to have a large chunk of cash that's earning tax-free, 5-ish%, something like that, and the ability to continue to fund that. Most people aren't willing to endure the discipline and the pain to actually get to that point, so they don't actually do it. That's my primary source. Straight up cash is an option, and obviously that's a drag. But there's an opportunity cost that sort of has to be analyzed with that. And then sometimes I put things in municipal bonds, just a liquid muni bond fund that's tax efficient and whatever, it gets 2 or 3%, something like that. And those are the primary three that I use. Sometimes in portions of the equity portfolio, I'll mess around with different bond stuff, but for the most part, those are the primary three horses that I use.
Thanks.
Yep.
Hey Ian, on that note, if you have, you say you hold a lot of cash or cash equivalents. So would you, if you have the cash and you're looking to invest in something, syndication or whatever, would you always use cash before you take money out of your life insurance and use it, you know, because then you're paying interest on that where, I mean, do you always deplete your cash first?
Yeah, I depleted up to a point, you know, like obviously you should have you know, sort of a baseline of operating capital that, you know, if you're just running a business, you need to have like a slush fund. If you're running your household, you need to have a slush fund. So you don't want to dip it too far, but yeah, like, you know, you don't want to pay for the use of money, use of capital if you don't have to. But I don't think too hard about that. Because my intention is to backfill that quickly if I'm going to deploy it.
Okay. Are there any other questions for Ian before we move to the next stage here?
Hey, Ian, I have a quick question. Again, thanks for your time. Like everybody has said, this has been wonderful. You know, when we started off to create Left Field, is to educate, and we've got people on opposite ends of the spectrum in between, right? People that are in a bunch of passive investments, some that are in none, some that are in a few. And oftentimes we'll hear, you know, it's the cold feet syndrome. People are scared. I'm just curious, kind of piggybacking off of Mark's question, what's your favorite investment?
Yeah.
Having 50 placements under your belt, have there been any that have gone just horribly wrong? And I don't want deal names or deal, you know, sponsor names, but just have any of them gone just so far south that you just didn't see it coming?
No, but I almost invested in a Ponzi scheme. And you know, the lesson there was I was close. I was looking at it. I was doing everything I could from a sort of a proxy diligence standpoint. I was like trying to find people who were successful in there, trying to find sort of resources that had invested there, and they were all coming back good. And something just didn't sit right with me. And, you know, I just kept just pecking away at it. And it's like, I couldn't pinpoint what was not quite right, but it was through more conversations. And, you know, there would be what I call these one-offs. They would say something, and it just didn't quite make sense. And it wasn't enough for me to question it. It wasn't enough for me to sort of challenge them, but it just didn't quite, you know, make sense. And you just sort of file that, and you know, your gut is smart. It's got like thousands of years of intelligence there, and we don't give it the credit that it deserves. And I'm thankful that I just like dragged my feet and I didn't do it. And you know, and as a story, like this is with Income Story. Maybe some of you guys are familiar with this, but basically I was sort of like trying to vet this thing out, and then I heard an advertisement for them on CNBC as I was driving in the morning. I'm like, what the hell are they doing, like advertising? And, you know, they were like, did this last ditch effort to sort of get investors. And then, you know, several weeks after that, the lid blew off, and, you know, the investigators were there and the guys in handcuffs, and, you know, it was a huge Ponzi scheme. And, you know, like that was, I could have gotten involved with that. I could have lost everything, could have, you know, and I probably deserved to, because I was still like looking at it too close and not trusting my gut for too long. I'm thankful that I didn't, but you know, that can happen. And that's the point where the learning lesson is, like, that can happen. Like, you don't know these people. You're listening to them on podcasts. You don't know what's going on in their life. You don't know if they're getting a divorce. You don't know like what their track record is, if they're drunk, you know, you just don't know. And like to hitch your hitch your wagon to one horse, I think is doing a horrible disservice to your financial future. Like you gotta like, you know, I know that there's advocates for somebody to like, you know, guard your one egg and like, you know, whatever. But I'm like, throw it out there, because you can't predict the future, and you don't want to get your knees chopped off. You do not want to like be out of the game. And I go into every investment expecting that the wheels can fall off, and like, I'm not going to get any return from that. And I mitigate that by doing my front end work. I mitigate that by diversifying, and I mitigate that by cash reserves, knowing that if it goes to shit, that's a learning lesson. I'm going to take notes. I'm going to, you know, chalk that one up to education. It was cheaper than my undergrad and cheaper than my med school, but I certainly still don't like to pay for it at this point. So.
Perfect. Thank you. Ian, this was fantastic. We definitely appreciate you you coming and chatting with us. You know, if you want to stick around for a couple minutes, that'd be awesome if you have the time. I would like to do real quick, because I'd like to get these meetings over in an hour, and I'm not counting the networking, so we have about 3 minutes. I want to ask 2 people to go off and introduce themselves just real quick. Just kind of tell you how your story into passive investing and what you're kind of into right now. If you can keep it short, that'd be great. Ryan, I'll have you go first, and then Jeff, if you wouldn't mind, after Ryan, just kind of giving a real quick overview of your situation as well. So Ryan, I'll turn it over to you. Ryan Stieg, right. Sorry, I know there's 2 Ryans, I just realized. Ryan Stieg, sorry.
All right, my audio has been cutting out just a little bit, so if you can't hear me, just give me the signal and I'll pass it on. So mine is, I really wish I didn't have to go after Ian, because Ian's is a much more formal and like intentional and articulate story than mine, but mine's a story of severe shiny object syndrome. And if you're watching our blogs here, Chad alludes to his, and mine is even more widespread than that. Started with the same purple book probably most of you read years and years ago, and then I sat on it for years and didn't do anything about it. And then probably like the rest of you, I jumped into podcasting at some point in time in 2015, 16, and got down the rabbit hole of turnkeys, and I've got a handful or more of those, and got into some other podcasting. And so when we jumped into the middle of it, I'll jump into the middle of my story, and I met Ian and Jim on the same trip on a podcast through the networking of a podcast, and Ian was the first person I met. And after my conversation with him, I go, I'm out of my league here. I don't even know why I'm here. And so if you guys are feeling that same way after listening to Ian talk, I did too. So don't worry.
And then he talked to me and found out he was in the right league.
So I've gone down every path to, you know, crypto and options and all around. But at the end of the day, I think I ultimately come back to a lot of the things that brought us all here tonight, and that's working with a group that you know, like, and trust, and really steering away from the mainstream, you know, 401k. I sat on a 401k committee at work just thinking, this just doesn't work. It just doesn't work. And so I've kind of totally shifted my mindset to cash flow investing rather than accumulation. So my goal now is to work on developing diversified streams of income versus a big pile of cash. So, you know, like I said, mine kind of goes all over the different rabbit holes that you can go in the podcast world. But ultimately, at the end of the day, my favorite is real estate syndication, where I can still hold my W-2 income and build passive streams of income outside of that too. So thanks, Ian, for talking tonight, and Jim for putting me after Ian. That's a lot of pressure. So
that's for sure.
Thanks, Ian, for your time tonight.
Cool. Thanks, Ryan. So Jeff, can you give us a minute or two on your story, where you are and where you're going?
Yeah, sure. Thanks, Jim. So everyone, I'm Jeff Geagan. Good evening. I'm a newbie. So I've been a big fan of Warren Buffett and Charlie Munger. I heard Ian reference him a couple times tonight, and I thought for me, stock was the way to go. I've been 100% equities and indexing funds for the last 15 years, just through, you know, maxing out all my retirement accounts. I was in real estate by an accidental landlord situation a couple times, and it was very active, and I hated every minute of it and said I'd never do real estate again. But I had a good friend from college tell me about Jim's story and what he was doing on the syndication side, and how it is really a passive, you know, this golden nugget, gem, hidden secret that really does exist, that I think I've been looking for in the last 20 years that no one really talked about. And so, yeah, I was just, I remember my first, you know, discussion or two about the syndications. I thought, this is way too hard. This sounds like a Ponzi scheme. Who am I going to trust in this you know, scenario, as I'm researching sponsors, it just sounded way too complicated. And I walked away saying, I'm not going to do this. And then you know, I think I got a little bit more curious and a little more curious. And then it's like, all right, I read a couple of books and I'm like, I got to do a deal. If I do one deal, it'll snowball and it'll lead to more. And so now I'm in my first couple and, you know, super excited about the opportunity, about growing the real estate side. So happy to be here and happy to be with the group.
Awesome. Thanks, Jeff. So, okay, real quick, January meeting, we're going to have hopefully an economist we're still looking for. So if you know a great economist, let me know. We're still in negotiations with one, Jameson. February, we have Jeremy Roll, who is like a prolific passive investor, very well known. I'm really privileged that we could get him. And then March, we already have the CEO of Harvest Returns, going to be a totally different thing. It's agriculture investing. So that'll be super interesting. And then the rest we're still trying to fill out. So at this moment, for those of you that want to stick around, I have assigned everyone to rooms. I have never done this before other than when I made my parents and sister let me try it out on them. And there was only 4, so everyone was in their own room and no one knew what happened. So I'm going to put you in rooms. The Sean, Chad, Ryan, and Steve and I will be the hosts of the room. And all we're going to do is have everyone who hasn't already said a little bit about themselves kind of just go around and chat for a little bit about what you're doing, and just so we can try to get to know each other a little bit. And I just got a notice that the meetings are always the 4th Monday of the month except for December. So, but I'll send stuff out. So we're not going to come back to this meeting. So after you're done networking, you can go ahead and go. If this doesn't work and everyone just gets cut off, my apologies, and I'll see you next month is the only thing I can say. Like I said, I'm learning as we go. So here we go. Let's see what happens. Now, you should be able to see something that says join. Hopefully. There we go. Holy cow. It worked. You guys can unmute.
Nice job, Jim.
Thank you. So we have Dana, Jeff Cook, Greg Baxter, and is it Petro? Petro, I'm sorry.
Yeah, good.
So I think all of you, except for Petro, know me, and Petro and I are scheduled to talk Friday. So I will, Dana, maybe if you can start. Dana's my neighbor, but if you can just kind of give us a little bit about how you got interest into passive investing, what your kind of path is, and your story, and then we'll kind of go around the horn.
Absolutely. Hello, Dana Randall. Like Jim said, we're neighbors. We've been neighbors for a little over 10 years now. So Jim's a good friend of mine, and what has got me interested in investing is really for my future. And we've talked a couple times prior to me joining with my wife and I, and it's just really trying to understand what I want to invest in the future. And I'm very, just like a few of the gentlemen that talked about here, I'm at a very elementary level at this. So really this is a lot of it's learning. I feel like every time I'm in one of these meetings here, I learn more and more. Took notes today. So it's definitely very informative. So I look forward to working with you. And Jim, thanks for inviting me to this group.
No worries. And just so everybody knows, Dana is in a deal already. He and I are in a group that invests together. We have 11 partners. So that's actually our name, but there's 11 people in the group, and we each contribute $100 a month. And then we also contributed a small amount, another amount to get us to the minimum. And we bought into our first investment last month. And so we're super excited. It's a bunch of people who haven't done this before. So it's been a great journey. All right, so we'll move on to Petro. You want to give us a little bit about yourself and your passive investing journey?
Yeah. So hi everyone. My name is Petro Barchuk. I am originally from Ukraine. If you haven't gotten that from my accent or my name, I've been in the United States for about 15 years now. I live actually in Philadelphia area, just about 40 minutes north of Philly. And that's where my day job is in my W2 is I am Vice President of Financial Planning and Analysis working for a medical device company. And my investing experience, so I had pretty extensive experience investing in just financial markets, stocks and bonds, but I've always been pretty interested in real estate. And first, I tried to get in there into real estate probably about 8 years ago. Started learning a lot, bought my first rental property, still have it. But then very quickly I kind of realized that, well, one is to scale up, you kind of need resources. There are a lot of strategy, no money down, burr, all of that, but it just wasn't for me. I had a day job, it's a lot of risk. So that wasn't working. And another thing is, what I realized is if you own something directly, you're not passive. Doesn't matter whether you activate it, and it did not work. So I kind of made a strategic decision to put it on a shelf and concentrate in my career, just kind of climbing the ladder. We started having kids. I have 3 beautiful little babies, 6, 4, and 2. So that was a period. And now though, coming out on the other side about 8 years later, I have a little more time and have a little more flexibility in my financial portfolio to allocate to real estate. So I thought, okay, well, let me get back to that. And I started going back into my books and reading. And then somewhere on one of the forums, I saw syndication. I'm like, what is that? I've never heard of it. And started reading more. And it's just like a light bulb right in your head. That's exactly like, I don't know how I never knew about this before, because it's just, I feel like it's right down my alley, because I'm very analytical. I like finance. I like what I do for a living, and it's, analyzing the deal and kind of figuring out the market. That's something that I could really enjoy, and it's passive, right? So it's two coins. Now I very new to this. I started looking into this, probably about a month. Right now, my short-term goals next 3-4 months is really just learn as much as I can. Jim, thanks a lot for inviting me to this. I feel a little bit like a stalker, because I went to your website and there are a lot of these videos that you uploaded from prior meetups. So I saw it, and I saw guys introducing themselves. So I feel like I know some people, nobody knows me, but that was great. And some of the speakers that you had was really good. And so, yeah, just next couple of months, my goals are learn, get my investment criteria really in good shape. Like one thing that I learned from my financial markets experience is like you kind of need to know, what you're trying to get out of your investment, right? You need to set your priorities straight. You have to understand your risk reward. And so I'm kind of working on that. And then a little longer term, 12, 18 months, really the goal to be in, 3-4 deals that meet my investment criteria.
Nice. Thank you. And, it's interesting. I think I told you this, but you're the first person that went on the website and sent an email through the website, and you did it when the thing wasn't working right. So I'm super glad that I actually got the email, because I've learned from one of my mentors that when you're building something like this, you just put it out there, warts and all, even if it's not ready yet, and just deal with things as they come. And so you were a great test case. I appreciate it, because I went back to my developer and said, what's happening? This didn't work. So thank you very much. And I look forward to talking to you Friday. All right. So Jeff, are you there? You want to chat a little bit?
Did you say Jeff?
Yes.
Oh, hey, yeah. Hey, Jim. How's it going?
Good.
Good. Yeah, thanks. I just, I knew you guys had the podcast today, and I just wanted to hear Ian. I talked to him last week. For those of you who don't know me, I do real estate syndications as a sponsor. We have several different investments that we're working on right now. One of the things that we're working on right now is a private equity fund that we are, again, working on, looking for deals and what have you. So it's actually very interesting to, listen to what our potential clients and passive investors are interested in and what they are looking for in a sponsor. So I'm not, I mean, unless there's any specific direct questions, if it's okay, I'll just kind of listen and just kind of hang out.
Yeah, absolutely. I'm glad you joined. Just a full disclosure, I am planning on investing in that fund, even though like Ian, I'm not really a fund guy, but when your fund has a model that makes sense, like your Jeff does, then I'm interested. And also, as I've told everybody, when Ian is interested in something, which he's also interested, that is just a stamp of validation for me, because I think Ian is just probably the smartest guy I've met in this field so far. So when I found out he was looking into your stuff, Jeff, I was like, all right, I'm in. Even though I'd already told you I was going to do it before that. So I'm glad you.
Yeah.
All right, Greg, you're up. Are you there? Hey, he's muted still, so I don't know if he's there. All right. Well, we'll assume that maybe Greg's taking a nap. But so just real quick before we log off, because this was supposed to be just a short thing, what do you guys think about these rooms? Is this a good way to just kind of introduce ourselves instead of going round robin with 20 people?
This is good. Yeah, I think it'd take too much time to do,
Yeah.
To do that. So yeah, just kind of mix it up, each month. Yeah, I think that'd be cool.
All right. Well,
I agree.
Awesome. That's all I have.
I agree also.
Okay, good. Well, thank you guys. I really appreciate you joining, and you're all on the email list, so you'll get all the invites to the other meetings. And if you I'm not going to try to send out a whole lot of emails, but I will send out a survey here or there, and maybe some blog posts. So just read the emails. If you have questions, let me know. If you find an error on the website, please let me know. And with that, we will see you. Pedro, I'll see you Friday, but everybody else, I'll see you in a month. So thank you very much, and have a good day.
Bye, guys. Have a good night.
Okay, guys. See ya.
See ya.